And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. There is intense interest in trying to access the shares of tech companies that are still private, like SpaceX and OpenAI. A closed-end fund, Destiny Tech 100, recently began trading on the New York Stock Exchange and is trading at a very large premium to its net asset value. But are there other ways to access private tech equity? Let's talk with Brett Winton. He's the chief futurist at ARK Investment. Also joining us is Howie Nigg, head of analytics and investment solutions from Forge Global, and Nicholas Colas from DataTrack joining me here at the New York Stock Exchange. Brett, I'll start with you. You and Kathy Wood launched the ARK Venture Fund in 2022. This is an interval fund. It also invests in private tech companies like SpaceX, OpenAI, and Epic Games. And it also owns public companies like Coinbase and Robinhood. Now, you just published a paper that caught my eye claiming that this interval fund is a better way to invest in private companies. Can you explain why you think it's a better way?
Yeah, actually, interval funds were designed specifically to allow everyday investors to invest in less liquid assets, and venture fits right into that idea. So with an interval fund, you don't have to be an accredited investor. You don't have to be, very, very wealthy to invest in venture exposures like OpenAI, and you get to invest at the net asset value. So you can buy daily at the value of the underlying positions in the portfolio, and then you can sell quarterly. And so you have a quarterly window in which you can kind of sell your position.
And I want to, this is a good educational moment to inform viewers what an interval fund is. So with an interval fund, you can buy at any time at the net asset value. That's the key. So there's no premium or discount. And you can sell to the company at set times on a quarterly basis. Am I right about that?
Exactly. And so that's why it's an appropriate vehicle for illiquid assets, because it allows for kind of the manager to prepare for the redemptions that come and make sure there's a pool of liquid assets that they can sell to meet those redemptions, and those happen quarterly.
So, and you own private and public companies. Why does the fund own both private and public companies? Like you own Coinbase, for example.
Yeah, the majority of the fund is in private companies, so roughly 80%. And then the public equities in the fund is to facilitate that quarterly redemption process. Frankly, it's an amazing time to invest in innovation, and we think both venture exposures and public innovation companies are incredibly well valued today to take a long-term investment over what's a unique decade in technological economic history.
Okay, Howie, let me turn to you. Private funds for qualified investors are also available. Forge Global recently launched the Forge Acuity Private Market Index. This is a market capitalization weighted index that tracks the performance of 60 late-stage venture-backed private companies, for example, like SpaceX and Epic Games. And I know you told me this is already being used in a private fund. Tell us about this private fund. Who is qualified to invest in it?
Right. So first of all, as a data provider and also as an index provider, liquidity provider in the space, we just see all these different types of fund structure coming to the space, which is very exciting. And I think very similar to the interval fund structure, the private fund is has a very similar redemption and contribution window. So you do transact at net asset value on a quarterly redemption basis. And I think for this fund, it is targeting institutional investors. So it's set up to take contribution from qualified purchasers, which are $5 million of net worth, and you just have to qualify to invest in the fund.
And so qualified investors here are net worth of at least $5 million. And what's the ticket size? I mean, it's totally institutional, right?
The ticket size is $100,000 at this point. Down the road, it might get revised up. The idea about the private fund with qualified QP, qualified purchasers, is to target the institutional segment. I think for any kind of asset class to mature, you're going to have retail players and institutional players at the same time. For this one, it's just the first step that we actually see index investing, and we're targeting, the fund manager is targeting the institutional segment.
Right. I mean, the obvious problem here with qualified investors is they cut out essentially the retail investors, yep. Right? I mean, I assume, Howie, that was obviously a conscious decision on your part, right?
Yeah, it's definitely a conscious decision on the asset manager's path. But if you sort of think about the next product and the next product and more products coming to the space, the idea here is that now it's possible for you to invest like an index discipline, just similar to the public market, right? So this index is now launched for the first ever pure play institutional index fund. That's not to say down the road we won't see products that actually cater to the retail segment, but it's still index tracking.
So, Nick, let me bring you in here. This highlights the fundamental problem here. Investors want access to these hot private tech companies, and it's really hard to do that. So, isn't the solution here to get more companies to go public long term? I mean, you're the old wise man here. Tell us what is your sense of watching this? People want these things and they can't get to them.
Yeah, it's funny because IPOs, the IPO window is what we call it on Wall Street, when a company can go public, when even the hottest company can go public, but even smaller ones, it opens and closes over time. The IPO window was last opened at the very beginning of 2022, and then it shut hard. And it hasn't reopened since. We've only seen a couple of interesting IPOs this year. There were very few last year. So as you said, there's a mismatch between investor interest in owning public companies and the ability of companies to actually go public in a relatively productive way. And that mismatch is exemplified by needing these kind of products.
So Howie, you said you imply somehow there's going to be something coming down the road catering to retail investors. What is it? Is it an interval fund like Kathy has and Brett has here? What's going to come down the road that you have planned?
No, I think the interval fund that Kathy has is actually a very sort of reasonable next step, other than these close-end, exchange-traded close-end fund, which is the fund that you're referring to at the outset. So I think interval fund is definitely a possibility. And down the road, there might be other ways to access this as well before we even get to, say, like a 40-Act ETF wrapper. Yeah.
Brett, this is an ETF show, and so I know the viewers are wondering, why can't we just deal with this problem and create an ETF that holds the shares of these private companies? It seems in terms of how you want to do this, that'd be the best way to address the issue. Why can't we do that?
Well, it comes down to the kind of liquidity and ability to access the underlying exposures. So you can't just invest in a private company without getting the permission of the company to invest in it. And that's an area where we do a lot of work, and actually we have an advantage because we're so well embedded in the technology community to be able to approach these companies and both provide them with information and then invest direct on the cap table of these companies. And so if you had an ETF that had to accommodate daily inflows and outflows, it would be very difficult to actually have those assets be automatically deployed into the exposures that you are promising to your end investors.
So there's the problem. I mean, to me, as an ETF guy, gee, wouldn't that solve the problem? But there's not enough liquidity to be able to pull that off, and you've got to go to the companies and invest in the shares. You can't do it. So long term, you're the wise man here. What do we do to get these companies to stop sitting private for so damn long and go public so people can access? People want to get access to SpaceX, and the company sits out there quite happy.
Yeah, I'd say two things. The first is we need a stable market for the rest of the year, and there'll be more IPOs. SpaceX may go next year. Who knows when OpenAI goes, or maybe there's a liquidity event. But it's going to be a runway. It's going to take some time. The second is, I think the public is now so much more in tune with understanding the power of disruptive innovation that the next raft of companies will come in right behind these. Once these go public, we'll get excited about the next ones. So I think this is going to be a perpetual problem because these companies won't go public as soon as people want to own them.
And Howie, you're sort of one of the experts. I talk with you often about IPOs. What will force more companies to go public? Is it higher interest rates? I mean, a lot of these companies are sitting around 10, 15 years old already. They're middle-aged, essentially. What is your thoughts on that process?
I think very similar to see the market situation of the public market. I mean, first of all, I do think that companies are actually staying private longer. So like it or not, there is going to be like, your guest was just saying that there's going to be a new batch of company that's going to fill the spot of the SpaceX of the world that have actually gone public. So I think the trend of companies staying private longer is definitely there. Now, the companies moving on to the public market and therefore sort of enjoying all the benefits of the public market is largely a function of how the public equity market is actually behaving, what kind of valuation can they fetch, the interest of environment, the macro environment, to your point. Yeah.
Brett, is this a structural problem? By structural, I mean, do companies want to stay private longer, not just because they get funding, but because they don't want to deal with the regulatory burdens of going public? They don't want to deal with the scrutiny, the quarterly reports. Is there a problem with the way the legal requirements of going public? I'm trying to figure out other reasons besides, interest rates are too high, or we're happy because we're getting funding, or the market's not right. Is there another reason that's preventing all these companies that sitting out there for years and years from going public?
Yeah, I mean, there are compliance and kind of like legal burdens, like to being in the public markets. I think that actually most public shareholders are not long-term enough focused, and that serves as both like unneeded near-term pressure on companies and can sometimes distract them from what they should be doing to differentiate themselves over the long term. And so we, as a manager both in the public and private markets, our emphasis has been we are investing in innovation over the long term and going to support management teams even as they make their way into kind of the public market journey to make long-term decisions that are in the best interest of the company and the long-term investors. And I think that's a real challenge. A lot of public market investors don't have that long-term view.
He's certainly right about that. But my point is, I remember the 1990s, and a lot of companies went public very fast. And the criticism was, they were incredibly volatile because they didn't have much of a track record. And yet, given a choice of having that, I would rather have that than this, where we have companies that are middle-aged that are still up. Look how old Reddit was before it went public. That's a long, long time to sit in the private market.
Another explanation could be that the challenges these companies are solving require a lot more capital than the dot-com bubble companies did. And so they require a lot more capital. It's much easier to go to a VC and have them write a bunch of checks as a Series C, Series D, and keep the company growing, rather than go to the public markets and say, okay, do an IPO, then do a secondary 2 years later, and do another one 2 years after that. It could just be these company managements prefer the structure of going to the venture capital community, who, as Brett said, do understand the challenges, do understand you've got to hold for a couple of years, and are going to be patient through their process, rather than going to the public markets and ask for those continuous rounds of fundraising to get to the end goal.
So Howie, you're sort of an expert on what's going on with venture capital. Where are all the VCs? Where are they at the point where we've got to get these companies out there? We need more dry powder, we need to cash in, or are they able to do some buyout where the company itself or other venture capital people essentially buy them out of early stage investing? Where are we in this whole game?
I think we definitely have been seeing things have started to turn around, because if you're focusing on the late stage pre-IPO set of companies, if you look at the Forge Private Market Index, one indication is that we have started to trend positive this year. The last 2 years have been negative. So I do think that you're seeing interest going back into the private market. As companies starting to go public, there will be new companies to replenish the inventory, so to speak. So things are definitely turning better, and the access to capital is actually becoming easier.
Brett, just let me go back to the ARK Venture Fund. Give us a sense of how you pick the funds here, the stocks here, the companies. I see Epic Games, 8%, Freenome, Relation Therapeutics, 6%, Anthropic, there's an AI play, 5%, SpaceX is about 5%, Databricks is about 4%. How do you and Kathy sort of come up with this stew of companies, and how do you decide which is weighted more or less?
Yeah, so we believe that this is a unique time in technological economic history, and that there are 5 major technology innovation platforms that are entering the marketplace at the same time: robotics, AI, multi-omic sequencing, public blockchain, and energy storage. And that's the framework by which we approach these companies. So our analysts are, I think, best in the world on technology, and then we select the companies we want to invest in, and talk to them, and then write checks.
And what can you explain the fee structure for this? Because sometimes it gets a little complicated. What's the, when you own this, what's the fee structure?
Well, I'd refer you to the prospectus. It's 2.75 in the prospectus, and end investors pay no more than 2.9%.
Okay. Where do you think this is all going to go? What do you, I mean, besides just whether SpaceX, we can speculate whether SpaceX is going to go public this year or next year, what's going to happen, who knows what Elon Musk is thinking right now. But where is this ultimately going to go? My hope is this is it, that we are seeing IPOs starting to come, and we're going to get a flood of IPOs this year. We've had $1 billion to $2 billion in the last few weeks. We're going to get the next few weeks. It's almost like 2019 again, when things were really opening up. Who knows? This could all end at any moment, but that's my hope. What's your
No, you're right, because ultimately the reason all this is important to public market investors is because these companies drive future returns. If you look at what drives returns over any 10 or 20 year time frame in the S&P 500, for example, it's really a handful of companies, and it's usually disruptive technology companies. So it's very important to get these companies public if you're an index investor. This is not an academic discussion because it's just private markets. This is super important to get these companies public. So I also hope we get a raft of new IPOs, and these kind of products continue to fund innovation and get the next raft of companies going that are going to go public in 5 or 10 years. It's a very important process, it's a very important dynamic that only US equity markets really enjoy. This is not a phenomena in Europe or Asia as much as it is here. No. That's why US stocks outperform, is because of this dynamic.
And Howie, Rubrik's slated to go public Thursday, right behind me here at the New York Stock Exchange. They're going to raise, I don't know, 750 million or so, but they're not profitable. So to me, this is an interesting test. Here's a big, well-known data company that's going public that's not profitable. So how is the market going to greet that right now? I mean, any thoughts? I'm trying to get this opening up story going in a little more detail.
Right. I think Rubrik will be a very interesting thing to watch because the last 2 IPOs, you actually had companies that, were somewhat profitable, and they were actually a lot more profitable than, say, for example, Rubrik, which is a most growth-oriented company. So I do think it is interesting to watch what the market reception is when it comes to Rubrik. Do people continue to optimize for growth, and that's about earnings per share and profitability? So we'll see.
And Brett, you're going to continue to invest in early and late stage companies. You want to drop any interesting names outside of the obvious, SpaceX names on us that you're particularly interested in these days?
Sure. I mean, we just invested in Figure AI, which is a humanoid robots company. And amongst all the technologies we look at, kind of our robotics forecast has moved forward the most because of the acceleration in artificial intelligence and the capability that kind of uncovers. So we think it'll be an exciting, business cycle for profound innovation that'll change everybody's lives.
Sounds like an ARK Invest pitch to me. Oh wait, you are ARK Invest. Thank you very much. Appreciate that. That does it, folks. An interesting discussion here. You see what a mess it is. It's tough to do this, but these people were trying to make it available to retail investors, and let's see if we can get these companies public sometime. That does it for this week's ETF Edge. My thanks to Brett, to Howie, and to Nicholas. And we've asked Nicholas to stick around and give us his broader perspectives on the state of the markets and ETFs and earnings for our ETF Edge podcast. That's coming right up. And remember, you can see all of our shows on our website. That's etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.